Remember 2008? 2008 was just a preview. The biggest wealth wipeout in decades is on the horizon. You have 90 days to act, or regret it forever. Listen closely. You might forget your girlfriend's birthday. You might forget your wedding anniversary. The consequences might sting, perhaps costing you a few luxury handbags. But if you forget one critical date this year, everything you've worked so hard for over the years could be wiped out in the blink of an eye. We stand on the precipice. A financial crisis, potentially dwarfing the cataclysm of 2008, isn't just a distant possibility, it's a countdown timer set to detonate within the next 90 days. The recent tremors rocking the stock and bond markets, causing sleepless nights for countless investors. That's merely the overture. The main act, a potential global asset meltdown, is scheduled to begin no later than 3 months from now. What you're witnessing, the US dollar's tentative slide, is just the opening salvo. The truly fatal blow, the trigger for systemic chaos, awaits activation at the end of this critical 90-day window. This is the final grace period the US establishment seems willing to grant. If the Federal Reserve and global powers fail to find an accord, the dominoes will fall, leading to a financial reckoning unlike anything witnessed in modern history. Yet, paradoxically, within this looming chaos lies an unprecedented opportunity for those holding the right keys, safe haven assets, to not only weather the storm but to seize generational wealth by buying at the bottom of a decimated market. What does this mean for you? Let's dissect the anatomy of this impending storm. The ticking time bomb, $6.5 trillion and the June deadline. Mark your calendars, the final day of June this year. Why is this date so critical it eclipses personal milestones? Because a staggering $6.5 trillion in U.S. debt, largely borrowed during the economic turmoil of the pandemic, reaches maturity. On that day, the world will learn precisely how the United States intends to handle this colossal obligation. U.S. debt? What's that got to do with me, you might ask? This complacency is dangerously widespread. Understand this, the $6.5 trillion maturing in June was borrowed when the Federal Reserve had slashed interest rates to near zero. To combat pandemic-induced economic paralysis and multiple stock market circuit breakers, the Fed vastly expanded its balance sheet, effectively printing money and lending it to the U.S. government and corporations at virtually no cost. Herein lies the multi-trillion-dollar problem. The U.S. Treasury's coffers are dwindling, holding only a few $100 billion, nowhere near enough to repay this debt. The only viable option is the classic rob Peter to pay Paul strategy. Issue new debt to pay off the old debt. But the financial landscape has dramatically shifted. The Fed, battling inflation, has aggressively hiked interest rates. Today, the U.S. must borrow at rates hovering around 4.5%. Imagine this: 5 years ago, I lent you $1 million, interest-free, due back this June. You spent it freely, unburdened by interest payments. Now, the due date arrives, but you're broke. You're forced to borrow $1 million from someone else to repay me. However, this new lender demands 4.5% annual interest. Suddenly, you're not just repaying the principal, you're shackled to significant ongoing interest payments, over $200,000 extra over 5 years in this example. This is precisely the predicament facing the U.S. government. It must refinance trillions of near-zero-interest pandemic-era debt with new, significantly more expensive debt carrying a 4.5% coupon. The fiscal burden is about to explode. By June, not only will the Treasury likely be scraping the bottom of its barrel, but it also faces the $6.5 trillion repayment cliff. Failure to repay means default. The only alternative is borrowing anew at punishing rates. This transforms low-cost liabilities into high-cost millstones around the nation's neck. The bond market's broken promise, from safe haven to toxic asset. But the problem runs deeper. The critical question is, who will lend the U.S. this new money? Historically, U.S. Treasury bonds were the bedrock of the global financial system, considered the ultimate risk-free asset. Why? Even with historically low interest rates, investors flocked to buy them. If you lent the US $1 million 5 years ago, perhaps you only got $1.02 million back, barely outpacing inflation. So why the frenzy? Because US bonds used to reliably appreciate in price. You could buy a $1 million bond, lend money to the US, and potentially sell it on the secondary market for $1.1 million before maturity. Bonds were not just debt instruments, they were speculative vehicles. Look at a long-term chart. Buying bonds in 2014 could have doubled your money by May 2020. The constant demand ensured liquidity, and the borrower was the world's superpower. Default was unthinkable. This perceived safety and potential for capital gains led many investors, including major institutions and banks, to employ significant leverage. Imagine starting with $1 million. You buy $1 million in bonds, pledge them as collateral to borrow $950,000, buy more bonds, pledge those, borrow $900,000, and repeat. Using leverage ratios of 5x or 6x, an initial $1 million could control $5 to $6 million worth of bonds. The Great Unwinding. Now, look at the chart from May 2020 onwards. Bond prices began a relentless decline. Why? A confluence of factors, critically including massive selling by major foreign holders like China and Japan. Consider the leveraged investor's nightmare, or the bank holding these bonds as collateral. A client pledges $1 million in bonds to borrow $950,000. If the bond's market value drops to $950,000, the loan is underwater. If it drops to $900,000, would the borrower repay $950,000 to retrieve an asset worth only $900,000? Unlikely. Banks, facing mounting losses on their bond portfolios, as tragically demonstrated by the collapse of institutions like Silicon Valley Bank, are forced to issue margin calls, demanding repayment. This forces leveraged players to sell bonds into a falling market, creating a vicious downward spiral. In just 3 years, the spectacular gains accumulated over the previous 6 years evaporated. So, we return to the crucial question: with bond prices plummeting, major holders dumping their inventory, and banks failing due to bond losses, who dares to buy new U.S. debt now, even at 4.5%? The allure is gone. The risk-free asset has revealed its fangs. The crossroads: patch the crumbling edifice or demolish and rebuild. The U.S. financial system, represented by the bond market, resembles an ancient, decaying mansion. You can keep patching the cracks, applying fresh paint, metaphorically, finding ways to prop up bond prices, but the foundations remain rotten. The risk of collapse persists. Or, you have another, more radical option: controlled demolition. Raise the structure and build anew from the ground up. For the U.S. government and the powers behind the Fed, this translates to a stark choice. Attempt to prolong the life of the current debt structure. This likely involves the Fed stepping in, but potentially on terms that perpetuate underlying weaknesses. Allow, or engineer, a collapse, trigger a systemic crisis, wiping out bad debt, crashing asset prices globally, and then rebuilding the U.S. economy from the ashes, positioning it to recover faster than rivals. In 2008, arguably, the U.S. chose a form of controlled demolition and subsequent rescue. Now, facing another ticking time bomb, which path will they choose? If you lived through the despair of 2008 or the panic of the 2020 market freeze, you understand that dismissing this as someone else's problem could lead to financial ruin by June's end. Conversely, those who anticipate the playbook stand to gain immensely. The Fed's inescapable role: savior by necessity. How can the U.S. government possibly navigate this refinancing nightmare without triggering default, especially if buyers for new debt are scarce? There's only one entity with the power to intervene decisively: the Federal Reserve. The Fed must step in. Why? Because a U.S. default is unthinkable. If the U.S. government explicitly states it cannot repay its $6.5 trillion obligation, declaring its bonds essentially worthless paper, the consequences would be catastrophic. Anyone holding U.S. debt sees their assets vaporize. Faith in the U.S. dollar, underpinned by the full faith and credit of the government, and its bonds, would shatter. A global stampede out of the dollar would ensue as investors scramble for alternative stores of value. Think of it like a bank run. You deposit money because you trust the bank's solvency. If the bank declares bankruptcy, you rush to withdraw whatever you can. Similarly, the world uses the US dollar because it's perceived as safer than many local currencies, intrinsically linked to the supposedly ironclad US bond market. If that link breaks, if the US defaults, the dollar becomes toxic. Global finance grinds to a halt. All US-denominated assets plummet. The powerful financial elites who influence the Fed cannot allow this. Their own vast wealth, tied up in the very system they oversee, would evaporate. Therefore, the Fed will intervene to prevent outright default. The notion that they would stand idly by while the U.S. financial system implodes is illogical. They have already ceased shrinking their balance sheet, quantitative tightening. The next logical step is expansion, quantitative easing, QE. Printing money to buy U.S. bonds is coming. The nature of the rescue: 2 scenarios, 1 outcome. The critical question isn't if the Fed will act, but how. This dictates the shape of the crisis and the opportunities within it. Scenario 1, QE with high interest rates. The Fed expands its balance sheet, printing money to buy government bonds, ensuring the government can pay its bills. However, they keep interest rates high, around 4.5%. Consequences: the U.S. government avoids default but remains trapped in a high-interest debt cycle, essentially working to pay interest to the Fed and bondholders. High rates stifle businesses, leading to bankruptcies, unemployment, and recession. Stocks and bonds likely suffer further. Winners: holders of short-term, high-yield debt, like Warren Buffett, currently loaded with cash in short-term treasuries. They earn high interest and can then use the principal to buy distressed assets cheap during the downturn. Scenario 2, QE with low/zero interest rates. Forced hand: the Fed is pressured, perhaps by a market crash deliberately triggered or exacerbated by government action, like aggressive tariff implementation, to not only print money massively but also slash interest rates back towards zero. Consequences: this requires a sharper, more painful initial crash to justify such drastic action. The goal is to clear the decks forcefully. Once rates are low and QE is flowing, it provides cheap capital for favored players to buy assets at rock-bottom prices, engineering a rapid U.S. recovery while the rest of the world struggles. Trump's preference: this aligns with demands often made by figures like Trump, force the Fed's hand to prioritize cheap borrowing costs above all else. Notice that both scenarios likely involve a significant downturn, even a crash, in U.S. assets before a recovery. The difference lies in the severity of the initial shock and the speed and nature of the subsequent rebound. This downturn is the prophesied wealth redistribution event. Decoding the grand strategy, a 4-act play. Is there a deliberate, calculated plan unfolding? The sequence of events suggests a possible multi-stage strategy designed to reset the global financial order to America's advantage. Act 1, devalue the dollar, ongoing, target, June deadline: make the $6.5 trillion debt cheaper to repay in real terms. How? By making the dollar worth less. A falling stock market often drives capital out of the U.S., weakening the dollar. If the dollar index falls 10% by June, the real cost of repaying that $6.5 trillion effectively shrinks by $650 billion. Could further market shocks be engineered before June to accelerate this? Act 2, elevate gold, ongoing while the dollar weakens, push gold prices higher. The U.S. officially holds over 8,000 tons of gold, the world's largest reserve, dwarfing other nations. Including gold held custody for other countries, like Germany, the total vaults approach 15,000 tons. Recent U.S. actions, like contemplating gold import tariffs, could further incentivize gold repatriation to the U.S. A soaring gold price significantly boosts the value of America's real reserves, offsetting dollar weakness. If the world shuns US bonds, let them buy gold, America holds that too. It's a hedge. Act 3, Trigger Global Asset Collapse, Potential Target. July onwards, the delayed implementation of certain tariffs, originally pushed back 90 days, could coincide with the post-debt deadline period around July. Could these be the catalyst for a broader global market meltdown? As global assets and currencies plunge, the Fed steps in with massive QE and near-zero rates specifically for the US. Capital flees collapsing global markets and floods back into the perceived safety and recovery potential of the US. Gold's role might then be deliberately suppressed to channel funds back into USD and US assets. Act 4, The Great Global Buy-Up. US financial elites, armed with newly printed, cheap dollars, whose value is now rising against collapsing global currencies, buy up distressed assets worldwide at bargain basement prices. The demolish and rebuild analogy completes its cycle. America emerges stronger, having reset the terms of global finance. Historical precedent, this isn't pure fantasy. Look back. Pre-2008 crisis, dollar weakened as capital flowed out. Post-2008 crisis, Fed launched massive QE and near-zero rates. Capital flooded back, dollar strengthened. Pre-2020 crash, dollar weakened. Post-2020 crash, Fed unleashed unlimited QE and zero rates. Capital flooded back, dollar strengthened. The pattern seems clear: orchestrate or allow a crisis, let the dollar initially weaken, rescue the US system with ultra-easy money, attract global capital back, strengthen the dollar, and then use that strong dollar to acquire global assets cheaply. Your playbook for the coming storm. If this analysis holds water, what should you do? Acknowledge the pattern, the current setup: weakening dollar, rising safe havens, like gold, perhaps yen initially, volatile US stocks/bonds, aligns with the historical pre-crisis phase. If you've been accumulating safe havens, the strategy's first half appears validated. Watch June/July closely, monitor how the US handles the debt deadline and whether tariff actions or other triggers ignite a broader global sell-off around July. Anticipate the pivot: if a global crash materializes, be prepared to potentially sell appreciated safe havens, gold, etc., and rotate into the beaten-down US dollar. Why? Because the next step is likely the Fed rescue. Follow the Fed's lead. When the Fed inevitably launches massive QE and likely cuts rates dramatically, scenario 2 seems more aligned with a full reset. This signals the time to consider buying distressed US assets, stocks, potentially bonds later. The influx of global capital should drive these assets higher. The final phase: once US assets have recovered and the dollar is strong, assess opportunities to deploy capital into undervalued international assets being sold off cheaply. Crucially, prepare now. Don't wait for the crisis to hit and then ask, what should I buy? Understand the potential roadmap. Internalize the strategy. Recognize the signals. Avoid common pitfalls. Don't catch falling knives blindly. Wait for confirmation of a bottom/Fed intervention. Don't panic sell at the absolute bottom. Have conviction in your strategy. Don't cling to losing positions hoping for a recovery. Cut losses where necessary according to your plan. Reject passive, buy and hold forever mantras. This environment demands active management and strategic rotation. Conclusion: opportunity favors the prepared mind. The next few months could reshape the global financial landscape. Whether it unfolds exactly as outlined or takes a different turn, immense volatility seems almost certain. This volatility represents both profound risk and potentially the last great opportunity for ordinary individuals to achieve extraordinary wealth transfer in this cycle. Even if the catastrophic crisis doesn't fully materialize, understanding these dynamics allows for better strategic positioning. If the opportunity passes, capital can be redeployed. But missing it due to inaction or ignorance could be a generational regret. The world stage is set, the players are moving, and the clock is ticking down to the end of June. Stay informed, stay vigilant, and prepare yourself. The storm is coming. Will you be swept away, or will you ride the wave? Time is not on our side. The next 90 days will separate the prepared from the panicked. Don't be on the wrong side of history. Subscribe now for exclusive updates, and let us know in the comments, how are you getting ready? If you found this video eye-opening, do us a favor, like, share, and subscribe to stay ahead. Your support keeps this channel fighting for your financial safety. Thank you, and stay tuned, the countdown continues. Remember, fortune favors the prepared mind.